Welcome to our webinar on export market attractiveness. Thank you for being here. I would like to talk to you today. We would like to talk to you today about this very important topic in exports, how to select your future export markets. We have designed this webinar for small and medium enterprises. We hope we are going to enjoy it. So let's go for it. What's the objective for us? We would like to share with you some insights on how to conduct market attractiveness studies, how to do your market selections, and how to do your market research. Let's hear from Miles.
Hey guys, so I'm Miles, a senior analyst in Euromonitor International's beauty and fashion team, working specifically in the fashion and luxury space. The company produces annual projects on a number of consumer goods industries where we cover the overall market size, competitors, distribution channels, forecasts, and all of the major trends affecting competition and market growth in between them. And that's what we're going to be adding to this webinar here today. What I'm going to be doing with this section of the presentation here is just to outline a couple of opportunities in ethical fashion using a structured approach that's quite common to how clients will ask us to approach a new market entry kind of project. Let's get into it straight away, and I'll explain as we go along here. So I am looking here at a global overview of the forecast growth rates for apparel and footwear. The idea being that I'm trying to pick out which regional markets are going to be the most attractive in terms of expected future growth. So the 3% for Asia Pacific here is the top, just slightly beating out Latin America as one of the fastest growing markets out of all of these regional markets. So that is total sales of all apparel and footwear products. That's footwear, clothing, dresses, all the rest of that. Just as a first initial guide. When we go and we look at the market sizing, a second interesting factor to start pulling out into our selection process is competition, because the market size is one thing, but one of the key strategic issues we spend quite a bunch of time speaking about at Euromonitor is the kind of competition any company is going to face once they enter a market. To give us kind of a baseline, I've looked at the overall rates of fragmentation for apparel and footwear. Fragmentation being how concentrated or less concentrated an industry is. Apparel and footwear, because of the wide diversity in consumer preferences, lifestyles, tastes, and dress codes, it leaves tons of room for small niche brands catering to specific niches. So it's one of the more fragmented consumer goods there is. So you can see that in 2018, the highest global share held by any company was 3%. Quite different if you look at some industries in, say, food and nutrition or in the retailing industry. And the combined market share in 2018 of the top 10 ranked companies was 13%. Now, that doesn't seem crazy, but when you consider that these top 10 are going to be all of the most internationally well-renowned brands and conglomerates, so Nike, H&M, Inditex, fast retailing, that's fairly small considering that all of these brands are ones we see and speak about almost daily. And then we see that in 2018, the share held by others or smaller independent or unbranded companies was 70%, extremely high considering that the major global players are everywhere in the world, take up so much space in terms of media and attention, but the share held by other smaller companies was extremely high. So apparel and footwear overall is a very fragmented industry. So then when we drill this down into individual regions, then we can start to pick up on some areas where fragmentation is a lot higher and might lead to some interesting targets for us. So here we are looking at a ranking by region of the combined share of the top 10 companies in each region. So we have all of the same regions we saw in the first slide, but what shows up as extremely interesting here is that Asia Pacific has the highest degree of fragmentation, or alternatively the lowest degree of concentration, where the top 10 ranked companies in Asia Pacific only account for 12% of total sales in that region. Now, What that could mean is quite a number of things. It could mean that it's very difficult for large players to gain share. It could mean that there are a series of cultural reasons that keep consumers wearing brands and fashion from a whole series of diverse, unbranded styles of clothing. But what it means initially for us as we do this process is that there may potentially be an opportunity for a player to enter Asia Pacific without having to compete as fiercely for growth with major international multinational players that have far more resources and access to marketing. It could be a very good opportunity for a player to enter a region that, compared to places like North America, like Western Europe, Australasia, you may have to face less fierce competition for growth. When we go again and we drill down into Asia Pacific, that same metric of the combined share of the top 10 companies, we can see some potential specific country opportunities start to come up. Again, this is all very strategic stuff. So all of the factors we brought up earlier about the cultural fit and ease of access and ease of doing business haven't yet been considered here. This is our first initial filtering process. So what we can see here really quickly is that India shows up as an extremely fragmented market where the top 10 brands, again, major international players everyone is familiar with, only accounted for 6% of sales. Now, there are, of course, a whole bunch of nuanced factors causing that, but there's potential here. That potential becomes way more apparent when we come back out of the regional comparison and look at how total absolute forecast value growth looks globally. So here we have the top 10 apparel and footwear markets by the total sales they are expected to add between 2018 and 2023. And we see China and India showing up at the very top above markets like the US and the UK, considering again that India is one of the most fragmented markets. It shows us some real potential as an entry target. Now, here's the rub. Many players, of course, have recognized those same dynamics and have moved to enter markets like China or India, trying to seek growth from new regions. So in the case of Uniqlo and H&M, both of those companies trying to expand and diversify away from slow growth markets, in Uniqlo's case, like in Japan, have found competition become far more fierce, even in markets like China, because domestic rivals have become way quicker to start adopting the fast cycle of turnover that has made the fast fashion model so successful. So this is a new phenomenon where previously players entering a emerging market, developing market, could expect to have a business model advantage in terms of their speed and resources. But Uniqlo in China especially, where it had seen really strong growth up until 2018, is finding it harder to increase its growth recently because of competition from really agile, responsive rivals like Peacebird and Mian City. And this is a dynamic that's affecting all of the apparel and footwear industry across several markets and has been increasing the intensity of competition globally. What does that mean? So we're going to combine a whole range of different sources of data to start coming to an opportunity that we can take advantage of. As competition has intensified, players have been drawn into this really fierce cycle of price declines, starting from the financial crisis and continuing on in the recovery years afterwards. What that has meant has been that players who are extremely agile, well-resourced, have faced declining profitability and tons of margin pressure as they keep going down this spiral of cutting prices. Over time, because of that fierce competition, players have decided to move away from the focus on price competition and try to reintroduce mid-range prices, trying to recover margins. It doesn't mean that fast fashion doesn't exist, but that the rate of price declines has been slowed overall as more players have tried to boost sales of prices not quite at premium, but not quite at that total discount level. So we've had the unit price contraction, which we've seen for over 10 years in the apparel and footwear industry, slow down slightly over the forecast period. So what does that mean? To me, that signals a significant potential opportunity for ethical fashion for a number of reasons. So we expect generally that players in apparel and footwear are going to start becoming far more active in broadcasting the origins of their production and sourcing as a way to differentiate themselves from the huge crowd of agile, quick, responsive players, and be able to start justifying to consumers why they shouldn't expect constant price declines and why they should then try to buy into the mid-range mid-range price points consumers are that these brands are introducing. That comes at a time when consumers are becoming far more aware of the impact of fashion on the environment and communities. So we've seen, a huge series of high-profile protests across some developed markets and developing markets where consumers are becoming far more aware publicly, and popular kind of awareness has focused in on consumers' attitudes to ethical fashion, to ethical production in a range of industries. So in the 2019 Consumer Lifestyle Survey we run, that's another section of data entirely, consumer sentiment, we've seen that over 64% of respondents in that survey actively said that they try to have a positive impact on the environment through their day-to-day actions. That potentially signals an opportunity. But as we had seen in an earlier survey, while consumers indicate this kind of sentiment, the reasons that consumers are willing to pay more for a product are disproportionately in favor of older traditional factors to apparel and footwear: comfort and the high quality. Sustainable production by itself does not encourage consumers to make significant changes in their spending. How then do brands try to use this ethical fashion strategy to differentiate themselves in targeting growth in these emerging markets? Well, the key factor I've brought up in several presentations is that there is a strong need to demonstrate tangible added value. The ethical fashion angle only plays out well when all things are equal generally, especially with millennial consumers. And we've done some research on the differences between millennial ethical consumers and Generation Z consumers, but for the most part, it's not enough to just appeal to consumers' good nature. Consumers are only likely to shift their spending when ethical production gives them some added value. The easiest places to add that value in apparel and footwear, for example, are products where there is an obvious difference that high quality production can give a consumer. So imagine a product like jeans, where consumers spend tons of time in the product daily, where fit is extremely important, where you can make a clear distinction between a high quality pair and a low quality pair, or sportswear or footwear or technical outerwear, as opposed to a product like, say, tops, where the quality of the product is more difficult to judge for the average consumer, and the ability to charge premium prices is far more connected to branding, which tends to favor larger incumbent brands anyway. Demonstrating tangible added value is the real key to being able to access this strategy. So there are some categories that tend to prefer that. When we bring our study back to the top 10 markets by forecast growth, specifically this time focusing in on jeans, we can see that India stands out far and above as the market expected to have the largest potential growth in sales of jeans to 2023, and potentially giving us a significant opportunity for an ethical fashion brand to start pursuing growth in an area that is more likely to encourage consumers to shift their spending. So this would be the real basic high-level strategic overview I would bring to a client before we then start spending time and energy going into the far more diverse factors of how they actually enter each individual category. We might then start paying attention to per capita growth in spending and then distribution channels, but this at least brings up a potential opportunity that some brands might have ignored, specifically ethical jeans in India.
Thank you for attending our webinar. We would like you to go global wisely